All right, so the housing recession has arrived, folks. That's what many experts are saying, pointing to a myriad of indicators in today's real estate market. That being said, there are others that are not seeing it this way. So in today's episode, we're going to be digging into both sides of this debate to find out whether the housing recession has truly arrived. To start, the Fed's aggressive efforts to raise interest rates are fueling fears that the American economy is heading into a recession. That, of course, is if you don't already believe that we are in a recession, but we'll save that question for another video. The full market recession question aside, a key sector that might already be in a recession of its own, the housing market has chilled off enough that some analysts believe it could enter into a downturn. As we all know, mortgage rates nearly doubled during the first half of the year, and this has had now widespread effects on the housing market. Fitch Ratings, a leading provider of credit ratings, commentary, and research for global markets, has recently published findings that indicate a severe U.S. housing downturn is possible, citing increasing likelihood that U.S. home prices could soon be falling by between 10 to 15%. As we discussed on a recent video, housing prices started to plummet in July in certain areas, with the greatest single-month drop in value since 2011. Home prices aren't the only thing falling. Home builder confidence has also fallen more than any time since the meltdown in 2008. And according to census data, sales of new homes fell 30% from a year earlier last month. According to Robert Dietz, he's the chief economist for the National Association of Home Builders, we are already in a housing downturn. He said that after a year and a half of post-COVID housing strength, this isn't just a retrenchment to a more normalized trend. He said this is definitely a weakening. That is significant since spending on housing accounts for up to 18% of GDP, and this sector usually leads to the recovery. So even though the Biden administration has touted labor market strength and consumer spending holding up, an extended downturn in the housing market would likely aggravate any potential recession the U.S. economy is headed toward. Again, if you don't already think it's in one. Homeownership has long played a central role in the economy as the main way that most Americans accumulate wealth. It has taken on even more importance during the pandemic, with white-collar Americans driving up demand while seeking larger homes that would enable them to work from home. Record low mortgage rates encouraged the surge in purchases, and homeowners raced to refinance loans, giving them stability and a foothold against the volatility that was caused at the time by COVID. While housing prices fell for the first time in 3 years last month, they were still higher than they were 1 year ago, thanks to soaring appreciation during the pandemic. But rising rates driven by the Federal Reserve interest rate hike have priced many potential buyers at this point straight out of the market. They cannot even get in if they wanted to. In a note on Tuesday cautioning that the housing market has further falls ahead, Goldman Sachs economists predicted home price appreciation will slow dramatically over the coming 2 quarters and drop to 0% in 2023. This will be a big change to the appreciation levels that we've been enjoying over the past 10 years, with homes having appreciated in value every year since 2012. Many will remember the years of having to bid 10% or more above asking price just to secure their house. All that has now changed within the past couple of months, with the worsening market causing sellers now to lower their asking prices. More than 1/5 of homes listed for sale saw price declines in July, according to Redfin. This was the highest rate recorded by the company since it started tracking this data back in 2012. Brian Colton, a senior economist with Fitch Ratings, actually had this to say on the price changes. Housing prices were elevated going into this monetary policy change, and this is a big interest rate shock that we're seeing. We're heading into a monetary tightening driven slowdown, and housing is going to be affected by that more than the economy overall. No one is truly sure how bad this is going to get, because the Federal Reserve is also cutting back on the basket of assets it is buying to stimulate markets, trying to fight inflation. The central bank had been injecting almost $3 trillion into the mortgage market through purchases of mortgage-backed securities in a process known as quantitative easing. And it's now allowing those securities to mature and fall off its balance sheet, and it's left the door open to selling them as a way to shrink its portfolio more quickly. Colton had this to say on quantitative easing. Nobody knows how much real estate prices, not just in the US, but globally, were increased by quantitative easing. But I think there's a pretty strong consensus that quantitative easing did boost asset prices and real estate prices in particular, and now we're going to head in the opposite of that, and nobody has a particularly good model of what that will look like. So we'll see. We'll see how his statements unfold. But it's not going to look good, according to Douglas Holtz-Eakin, an economist and chairman of the American Action Forum. In an interview, Eakin said that housing is going to be disproportionately bearing the brunt of this disinflation, and the next couple of years are going to be tough. But according to Zillow's senior economist Jeff Tucker, it could be worse. Tucker points out that inventory has been flattening over the past few weeks. Sellers have started rethinking listing their homes right now. New listings fell by 2.8% in July, according to data from Realtor.com. Tucker believes that we're not on a runway slowdown headed for a crash. He said, and I quote, "There's this kind of supply pullback following the demand pullback of earlier this summer, and I think that's kind of buffering the market from seeing prices fall substantially." Chairman Jerome Powell recently warned that a campaign to curb inflation will bring some pain to households and businesses. We talked about that on another recent video. Now, looking forward, the strength of the housing recovery is really going to be dependent on where the economy is going. Once inflation recedes, mortgage rates will drop and demand for housing should rebound. Now, the supply of existing homes for sale has increased this year, but it remains below its pre-pandemic levels. Redfin chief economist Daryl Fairweather had this to say on the recovery. "Things are going to turn around probably sometime next year, but I'm not sure how positive a turnaround it will be, if it's going to come back full steam or if it's going to be a lackluster recovery because of the economic backdrop. It was just a couple months ago the housing market was in danger of overheating. This is definitely a necessary evil in a way." But this necessary evil is having widespread effects on other sides of the housing market as well. The U.S. mortgage industry is seeing its first lenders now going bankrupt following an abrupt jump in borrowing rates. The wave of bankruptcies to come may be the worst seen since the burst of the housing bubble some 15 years ago now. Fortunately for us, this time around, there is no systemic collapse coming because there hasn't been as much borrowing overhang and because the big banks pulled back on mortgages in the wake of the financial crisis. But more firms are now controlled by standalone lenders. As mortgage volumes have fallen sharply this year, many are struggling to stay afloat. According to Nancy Wallace, she's the chairman of real estate groups at the University of California, the nonprofits are not well capitalized, so when the mortgage market tanks, they're in trouble. Back in 2004, only about 1/3 of the top 20 lenders in the refinancing business were independent firms. Last year, 2/3 of the top 20 were not bank lenders. Since 2016, banks have seen their market share drop to around 1/3, down from about half, according to Inside Mortgage Finance, a news and data provider. Many so-called shadow lenders are set to come out relatively unscathed by the slowdown, but a few lenders have already stopped operations or dramatically reduced their operations, including End Sprout Mortgage and First Guarantee Mortgage Corporation, which I believe was really big in the first lien HELOC space. Both specialized in riskier loans, not subject to the government's guarantee. First Guarantee, the firm majority owned by the fixed income behemoth Pacific Investment Management, filed for bankruptcy, saying it failed after making loans earlier this year that fell in value. Once interest rates started rising, lending volumes dropped throughout the sector. According to court documents, that means that companies could no longer find enough new loans to pool together or secure enough funding to continue operations. First Guarantee employed 600 people before filing for bankruptcy in June and then made $10.6 billion in loans last year. Days before seeking court protection, the company laid off 471 of its workers because it wasn't getting enough funding to get through the cash crisis. So how did independent lenders, which run the risk of being over leveraged, gain so much of the market share? This happened because banks pulled so heavily from the sector in the wake of the financial crisis in 2008, which began because of too much mortgage-related borrowing. Regulators have frequently encouraged that pullback, and it is still happening. For example, Wells Fargo, Wall Street's largest company in U.S. mortgages, is planning to scale back its mortgage empire, according to a report from Bloomberg. Unlike banks, standalone lenders typically have no contingency programs that they can turn to for funding when times are tight, nor are they guaranteed deposits. They depend on loan lines, which are typically short-term and dependent on the mortgage prices. So they are subject to margin calls when stuck on a bad asset, and this can lead to bankruptcy. Many independent lenders manage their risks very well, and the picture is not quite as scary for lenders that do work heavily with government-backed companies such as Fannie Mae and Freddie Mac. They often can access emergency financing from government-sponsored enterprises should they face difficulty. But those lenders who are making riskier loans and who do not often partner with government-backed companies have few options when facing a margin call. A big reason these companies are struggling is because loans cannot go to the GSEs or government-sponsored enterprises to get funded. Tight financing options are made more painful by the tightening fiscal conditions, and many more lenders are seeing their lending values fall. The recent rise in interest rates is beating out home loan values made only a few months ago, which means a mortgage made in January that was not subject to government's guarantee might have traded somewhere around 85 cents on the dollar as of early August. Lenders typically look to write loans for around 102 cents to cover their front-end costs. For a lender who makes loans down to 85 cents, losses can be devastating even when not realized. Now, on top of this, overall mortgage applications are down by more than 50% so far this year, according to the Mortgage Bankers Association. These economic conditions are prompting banks, which offer lines of credit known as depository banking, to issue margin calls and reduce their lending. And banks have emergency funds that they can draw on during times of crisis, and that often allows them to keep themselves afloat during difficult times, but it's not universally true, as emergency financing from the Fed is generally available only for solvent institutions that stand a chance of recovery. In the most recent economic downturn, so many banks had so many bad loans and struggling assets of every type that hundreds failed. Fortunately, the numbers of lenders going under right now remain low. So don't expect to see a crisis like the one in 2008. Lessons were certainly learned from that experience, and the market is set up to avoid a similar catastrophe in the future. There are a lot of moving parts to the housing market. Focusing on any single part may give you an indication that things are looking bad, while other spots may give the exact opposite indication. It's important to keep our eyes on all aspects, trying to judge them together. And yes, it's quite messy right now and certainly volatile, and it's complicated to do this, but the end result gives us a lot more to work with as we focus on making the most out of any situation the housing market finds itself in. Cash flow is the goal, folks, always. So keep your eyes and ears open in the coming months as the housing market continues to evolve. I, for one, am doing everything I can right now to make sure I have the capital available to leap on the opportunities that present themselves. This means keeping my expenses low while simultaneously increasing my cash flow through various streams of income, along with accessing more and more capital, these debt weapons. Now, for anyone that's new to the channel, we do talk about strategies for cutting unnecessary costs while also building cash flow producing empires. Make sure you subscribe if you haven't already so you can catch every video. Be sure to check out all the videos over the past number of years, folks. You can go back 5, 6, 7, 8, 9 years ago, and everything we talk about in those videos is still extremely relevant today. Now is the time to implement the strategies we talk about. Inflation, which has been severe this year, can be helpful if you're on the receiving end. And even just recently, I saw a 25% increase to prices on just one short-term rental property that I used to live in Colorado. It's still my primary residence. I rent it when I'm here in Florida working. That property pulls down right now almost 6 figures per year. Costs on that property total roughly $45,000 per year. That's with everything. PI, TI, utilities, maintenance, inventory, stocking all of the amenities. So I'm left with about $55,000 a year, which all but covers the cost of the property that I purchased in Florida to use while I'm working in Florida. So while I can stay for 6 or 7 months in Colorado and come out to Florida or travel in an RV the rest of the year, those costs are entirely covered by that short-term rental property. Now, I rented that property this August for a total of 28 days to a family that came in and used it. It cost them a payout to me of a total of $8,000. So that's after all the expenses to VRBO. My take was $8,000, just shy, 79 and change. Next year, they already rebooked that property, and it's only for 21 days, and the total payout to me is just shy of $9,000. So I'm making $1,000 more, 12.5%, 13% more than I did this year from the same family with 1 week less. So instead of staying 4 weeks, they're staying only 3 weeks, a 25% reduction in stay with a 12.5% or 13% increase to the payout to me. That's where price increases can serve you, and anyone can technically do this. You could rent your home through short term if you chose to, if you're in a location that allows it. Perhaps that's something you could think about orchestrating. Otherwise, it's just all about being creative. There are more ways right now to make money than ever before. It's about taking the time to research things you're passionate about that you could really get up and feel excited for, and then putting the time and effort in consistently on a day-to-day basis. Consistency is the number one ingredient to success, but there are more ways to side hustle your way into a tremendous empire than ever in history. So if you're serious about up-leveling yourself, now's the best time to do it before things get even hairier. While there are certainly going to be downturns for others, for some, for many, money is made while there's blood in the streets. So it is a bit of a double-edged sword. Just be sure that you're right on the right side of that blade, my friend. All right, until we see you on the next video, thank you so much for joining today. Make it a great day, and keep on cash flowing. See you soon.